5 stocks to buy for 2025. Hey guys, hope you're doing well out there. It has been a fantastic year to be invested in the market. The S&P 500 is up nearly 27% year to date. We're coming off a fantastic 2023, and now we're closing out another fantastic year in the markets. That is 2024. So congrats to all of you guys. Congrats to anyone that has been investing throughout the years. Over the past couple of years, you've probably done fantastic this year. Your portfolio is probably near all-time highs. I know mine is, and so it's been a great feeling now closing out the year. So as we look ahead into 2025, the question lies, how do we position ourselves to be successful, not just next year, but looking ahead to the next 3 years along with the next 5 years. So I'll highlight 5 of the stocks that I am most bullish in heading into 2025, but also continuing to hold throughout the next couple of years. These are long-term picks, so not really looking to be in and out of these or swing trade these. These are long-term positions. So we'll get into the 5 picks that I have, but before we do that, I want to go back and revisit how are my top 5 stocks to buy for 2024 performing. So last year, about the same time, in fact, almost a year ago to the date, I put out a video saying 5 stocks to buy for 2024. And well, some of them performed really well. One of the picks was Amazon, which is up nearly 50% year to date. Meta was the other pick, up nearly 80% year to date. PayPal up nearly as well, 48% year to date. But there were some losers that I highlighted back in the end of 2023. And those being Nike, which is down nearly 28% year to date, along with Pepsi, also down 6% year to date. So overall, you had some outperformance, namely in your mega cap tech, along with fintech, and really PayPal, which was trading extremely cheap back then. You also had some underperformance from your consumer staples and your consumer discretionary names like a Nike and Pepsi. And keep in mind, all of this is in relation to the S&P 500 absolutely soaring, up 28% year to date. In fact, for these tech names, it's probably better to compare them to the NASDAQ, which is up nearly 33% over the past year. So keep in mind, by no means am I the perfect investor out there. In fact, I've made some bad picks and bad calls, but what I want to point out is it's difficult to judge a stock performance really over a 1-year time period. I think that's a pretty short amount of time, and you can expect some volatility. Really over 3 years, over 5 years is when you, in my opinion, I would say it's better to look at the performance of these companies and really compare them against the S&P 500, because in the short term, you can have some fluctuations. But the thing to remember is these are long-term picks, long-term meaning a couple of years out, at least nearly 3 to 5 years. And so over that time period, I think that's a better judge for performance. Now, as you head into 2025, I think if you have any of these positions in your portfolio, I think the management teams running these companies now are phenomenal. I think the brand and the businesses underlying these companies remain strong. And so heading into 2025, if you still continue to own and hold any of these companies, I think you'll do relatively okay. Keep in mind, Nike and Pepsi also pay out that dividend. And so your year-to-date performance isn't nearly as bad as you see on screen. But keep in mind, what has worked in the past may not necessarily work in the future, and vice versa. What hasn't worked in the past may continue or begin to work in the future. We're coming off the year with tech stocks flying absolutely high, the valuations also beginning to be stretched. So maybe next year or the year beyond, you see a rotation once again back into some of your cyclical and your consumer names like Nike, like Pepsi. And so being positioned in any of these stocks, I think moving into the new year, I think you'll do just fine. You'll also be able to sleep easy at night knowing you hold some great quality companies in your portfolio. Now, that was enough on the performance of 2024. Again, congrats to anyone that has been investing in the markets. With that out of the way, let's take a look at the 5 stocks to buy for 2025, kicking it off with a repeat from last year. Yes, we have Amazon.com. Basically, Amazon, I think you can expect to see on a top 5 stocks to buy list every year, probably for the next decade. In my opinion, this company has such a long runway of growth ahead of itself. They're doing so many things right that it's just difficult to bet against Amazon any given year. And the valuation is not overly egregious at this point either, which makes it just all the more reason to continue to buying and holding shares of Amazon. So year to date, you saw that performance up nearly 50% over the past 1 year. You're up 53%, and you stretch it out 5 years as well. You've done phenomenal, up 160%. And so that's why I tell you these stocks are long-term buy and hold investments where you stretch it out over 5 years and beyond. You'll do just fine, even if in the short term you see that fluctuation. Now, with Amazon, the first thing we always have to point out is everything that Amazon owns. They are in so many verticals that they just have their hands in every single industry, and you're basically always competing against Amazon which makes it very difficult to pretty much run any other business. And so they're, of course, in the e-commerce space with Amazon.com. They're also in media and entertainment with, of course, Prime Video. They also own Twitch. They also are in grocery and retail with Whole Foods. They're making a push into healthcare and household. They, of course, have their devices like Alexa, also like the Amazon Ring machines. They also have their play into autonomous driving and mobility through their sort of moonshot project, which is Zoox. Not many people know of that. And again, of course, the cash cow remaining AWS. They have so many software technologies pioneered by AWS that are basically a standard in the software industry as well. And lastly, probably one of the most undervalued pieces of Amazon, in my opinion, is their logistics side of the business. They're probably delivering more packages than UPS and FedEx at this point. And so they have a very, very well flushed out logistics business, including warehouses along with their transportation and really planes and trucks and all that. And so if someone was to ask me to describe Amazon's moat, I would basically show them this picture that Amazon is in so many verticals. It's just so difficult to compete against them. They have the cash to now go ahead and invest heavily into different parts of their business and see those returns. Now, the thing I'm most bullish on with Amazon moving into next year and beyond really is the fact that this company is going from a revenue growth company to a profit growth company. The profits and the operating profits over at Amazon are absolutely exploding. You saw on the North American e-commerce side of the business, you nearly doubled your operating income from 8.5 up to $15.7 billion. This is over the last 3 quarters. So over 9 months of Amazon, you've doubled your operating income in North America. On the international e-commerce side of the business, you've gone from a loss of $2 billion to now a gain of $2.5 billion. Again, on the operating income side. And then of course, the cash cow, which is AWS, going from $18 billion up to nearly $29 billion over the last 9 months at Amazon. So the profitability is really, really what excites me over at this company. I believe in 2025, they'll continue to push the pedal on the metal as it comes to profitability. I would fully expect the operating incomes on really all segments of their business to continue to move in the right direction. The other thing that makes me so bullish on Amazon, not just next year, but beyond, is the free cash flows. This company has been growing free cash flows consistently and now basically at a run rate of nearly $50 billion on a trailing 12-month basis in terms of free cash flow, which again was up nearly 123% year over year. And you saw this decline from Q2 to Q3. Keep in mind, Amazon is really heavily investing in CapEx at the current time as they're looking to build out those data centers, looking to buy all of those H100s and Blackwell GPUs from NVIDIA at this point. And so in the near term, you're seeing that cash flow take a small hit, but keep in mind the long-term goal of optimizing free cash flows is still there. And I think, in my opinion, Amazon's still a long way away from optimizing those free cash flows. And when they do optimize them, boy, are they going to look amazing. Now, from a revenue perspective, you still continue to expect nearly 10% revenue growth into next year. You look ahead to 2026, another 11% growth year on the top line expected. And keep in mind, you're growing revenues off a base of nearly $640 billion. To grow that by 10% is not easy. There's not many companies out there putting out these revenue numbers. Probably Walmart is your only other competitor putting up these kind of revenue figures. So $700 billion in full year revenue is what you're expecting over at Amazon. And while you're seeing that EPS growth decline compared to the growth we saw this year, you're still expecting another 20% bottom line earnings per share growth figure into next year. So there's just a lot of exciting things going over at Amazon. They have a lot of levers to pull in terms of making their business more profitable. You also continue to see the international e-commerce business stop losing money and now earning money on an operating basis. There's just, again, a lot to be excited about as it pertains to Amazon. So that is the first of my 5 stock picks into 2025. A pretty simple one. We covered it last year. I believe it'll perform just fine into 2025 as well. Now, moving on to our second stock pick, and that is Uber Technologies Incorporated, ticker symbol Uber. So this is a first here on the channel and probably a pretty divisive pick. Uber is probably, I'd say, a contrarian pick at the current time because year to date, you haven't done well with your shares of Uber. You're basically flat on a year-to-date performance, but over the past 6 months, even over the past 1 month, shares have taken a beating, down 14% over the last 30 days. Now, with Uber, there's really a lot of black clouds hanging above this company over the past, call it month and a half. We'll be sure to address those one at a time as we cover this stock. Now, the first thing I want to point out with Uber is they are partnering up with McDonald's in Canada in order to deliver Uber Eats, probably at a cheaper, more discounted price. Yeah, that's on 0 delivery fees and 5% off. So this might look like a headline that's relatively small, but underlying this is really what makes Uber differentiated against competitors. This is really what gives Uber its great network effect, and understanding network effects is, in my opinion, the core to understanding Uber. They have two parts of their business, mobility and delivery, along with a smaller freight segment. But for this analysis, we'll largely ignore the freight side of the business. But for mobility and delivery, the network effects is really what makes this company so compelling. And one of the things that makes the network effects on the delivery side so exciting is that you have all these restaurants partnering up with Uber Eats, which allows customers and consumers to have lower delivery fees, lower prices, which in turn bring in more consumers, which again in turn brings in more restaurants. And so that flywheel effect of adding more consumers along with adding more restaurants allows them to grow that delivery network, which in my opinion is so very crucial to this company. Similar story on the mobility side, you have more drivers, which brings down prices for consumers, which in turn incentivizes more drivers to join the platform. So that flywheel effect, both on the mobility and delivery side, is really what creates the network effect, which I think positions this company extremely strongly. Now, the other thing you got was a Toast integration and partnership with Uber in order to reach more diners from a commission-free delivery perspective. So again, similar story, might seem small, might just graze the headlines, but I think this is what really gives Uber its underlying network effects along with its technology advantages. So these little things, understanding them is key, in my opinion, to understanding Uber's business. Now, the other thing you got was an FTC probe for a possible consumer law violation as it pertains to Uber One. So Uber One is the subscription business for Uber. I think it gives you cheaper or maybe free Uber Eats delivery. It also gives you some discount on your Uber mobility rides. And so the FTC is probing Uber after consumers said and really complained that the Uber One subscription was signed up without their permission. It also made it difficult to cancel. Now, I think you had someone come out from Uber and say that they'll continue to, of course, answer those FTC questions. They also have an Uber One cancellation process that members can cancel their membership easily in the app. In fact, the majority of those cancellations take 20 seconds or less. So in my opinion, not a huge deal. I think this FTC probe largely will be figured out as it pertains to Uber. I think you also have the new Trump administration coming in. You will have some changes over at the FTC. And so I think maybe these probes and things of that nature will likely begin to lessen moving forward. So really, I think nothing to worry about there. Pony AI is a company that's recently gone public, and Uber is one of its backers. In fact, I believe Uber has a nearly $10 million investment into the shares of Pony AI. So this company makes autonomous vehicles, and really why I'm mentioning this story, which again might seem small, is basically this is one of the ways that Uber can play its hands in the autonomous vehicle, in the robo-taxi market. First of all, it can probably go ahead and back some of these smaller players that are looking to develop these autonomous vehicles and probably looking to develop a competitor to Tesla and Waymo. Now, to some investors, this might not be a great sign because Uber is going ahead and spending its nearly $10 million worth of cold, hard cash into some AI startup that may or may not see any success in the autonomous vehicle space, which again is a very difficult technology, really difficult challenge to figure out. So to some, this might seem like a burn of money. To others, it might seem like this is sort of their way, and at least one of the ways that they can play their hands into the autonomous vehicle and robo-taxi field is really backing the development of any AV companies outside of Tesla and Waymo. Now, speaking of Waymo, Waymo did expand its services, or at least announced to expand its services to Miami, I believe in 2026, with the help of another fleet management and ride-sharing company, that is Move. Now, the things you need to know is, first of all, Move is a company that's backed by Uber. In fact, they have a global partnership with Uber, which again led a $100 million Series B funding. And so you see what they did with Pony AI is probably something similar what they're doing with Move, where they make an investment to back these companies up. And then if those companies eventually go public or see success, Uber will likely be not just a great partner, but also probably see some share of the profits there. So Waymo, which is again the second, probably number 2 most likely company out there right now to put out autonomous vehicles behind Tesla, is of course a unit and backed by Google. They of course have rides in San Francisco, I believe, in Los Angeles, different parts of California, where they're already doing upwards of 150,000 autonomous rides per week. Now they're expanding in the cities of Phoenix along with Miami in 2026. They're also planning to expand in Atlanta and Austin, where they'll partner with Uber directly in order to manage their fleet. So this company like Waymo is really the one that develops these autonomous vehicles, but in different cities, what they're doing is they're trying out which ride-sharing company, really which fleet management platform will be the best for Waymo. So I believe in California, they went through the Waymo One app where Waymo themselves were managing their own fleet. I believe in Miami and Phoenix, they'll use the help of Move. In Atlanta and Austin, they'll go through Uber. And so I think Waymo is out there testing out the waters, testing out the market, seeing which fleet management company really out there that is the best in order to manage and service these autonomous vehicle rides for consumers. So you have some positive and negatives here. The positive could be that if Waymo comes out and determines that Uber themselves is the platform of choice, they are the platform that really manages the autonomous vehicle fleet for their consumers really well, they're the platform that really aggregates all that demand really, really well, then they'll just partner with Uber moving forward for basically the entire rollout of their autonomous vehicles. The way it could backfire is that if you have different competitors like Move, like maybe even just Waymo themselves, realizing that, hey, we don't need Uber to manage our fleet, we can just manage our fleet ourselves, then yeah, Uber absolutely will be sort of cut out from that middleman position and will be hurt. So my thesis behind Uber really lies on the basis of, will Tesla and Waymo be the end of Uber? If we answer that question, I think a lot of black clouds that are hanging over the stock, at least in the near term, will begin to fade. So I believe in the short to medium term, if I had to answer that question, I would say no. And there's a few reasons behind that. The first of all is because in the short and medium term, I think autonomous vehicles are still in fact, a number of years away. I think you're still at least 3 to 5 years away before you see meaningful autonomous vehicles really across all the cities in the US, and let alone cities internationally where you have more regulation. Now, certainly you have less regulation coming into the US over the next 4 years, which could expedite the rollout of autonomous vehicles. But I think in the short to medium term, also internationally, you're probably still a ways away from having large scale autonomous vehicle rides. And so in that time, Uber will continue to chug along with its core business of mobility and delivery. They'll continue to print tons of revenue, and now that they're profitable, they begin to continue to print tons of cash flows as well. The question really begins to be a bit more uncertain as you pertain to the longer term. If you look ahead 10 years out, you'll probably expect a lot of these rides will be autonomous vehicles. You probably don't have a driver in a lot of these cars moving forward. And so long term, there could possibly be that Tesla and Waymo could be the end of Uber. Now, the reason I don't think this will be the case is because, first of all, Uber has massive scale and massive network effects today. We talked about some of those network effects as it pertains to the delivery side of their business. But again, on the mobility side, you have a very, very well thought out platform, a very well thought out tech stack that is very difficult to duplicate. And the number of users and drivers that they have on their platform really is what causes that network effect to be very, very important. So I think Uber is one of the only companies that has achieved that, and I think that will be their advantage. And so maybe in the long term, Uber still remaining one of the only companies that has that scale and network effect. The other thing, what I think Uber really excels and succeeds, is because they're based on a convenience-based business model. We as humans are naturally very lazy. If we want our food, we want it delivered to us. If we want to go somewhere, we want to sit in the back and be dropped off to our destination. And so Uber's business is really based on convenience in terms of mobility and delivery. And I think that's why they've continued to succeed. That's also why their business remains very sticky. And as you have new users join the platform, they remain on the platform, because once you experience that convenience, it's difficult to go off of it. The other thing you have is Uber is one of the only companies to have achieved profitability both with their mobility and delivery business. So if I want to give you an example, Lyft is probably the only other competitor to Uber out there, but what they've struggled with for so long is profitability. In that sense, Uber has far, far outperformed Lyft shares, and simply because they've been able to achieve profitability on that mobility side. A lot of it is due to that scale and network effect. As it pertains to their other competitor in the delivery business, you can take a look at DoorDash, which again has been wildly successful themselves, but again, it's a company that's lacking profitability as it pertains to the delivery side. We'll take a look in just a second. This company, Uber, has achieved profitability on both the mobility and delivery segment. The other reason what I really like about Uber is the fact that it's an asset-light platform business. You're not buying a company that's actually making cars. you're just buying a company that has a marketplace in order to aggregate demand for not just drivers, but also consumers. And so you're buying a technology company that's essentially a platform and network business. Now, as it pertains to autonomous vehicles and robotaxi into the future, I think the way Uber can win, really one of the ways Uber can win in the space moving forward, is if they become an aggregator of autonomous vehicle demand. Now, this is on the basis that there are multiple robotaxi offerings out there in the market. So let's say you have GM producing their own robotaxis. I know they shut down Cruise recently, but let's assume these OEM auto manufacturers are able to roll out their own robotaxi offering, simply seeing how juicy the margins are for Tesla and Waymo if they're able to be successful. You also have the possibility that you have many startups entering in this field. We just took a look at Pony as one of them. You also have the option that you have Chinese autonomous vehicle makers that, again, are putting out robo-taxis as an offering, at least outside of the US. And so you have multiple robo-taxi offerings. Uber can be the platform of choice in order to aggregate all of that autonomous vehicle demand. If, as a consumer, you're trying to go from point A to point B, you don't really care if you get picked up in a Tesla or a Waymo or any other autonomous vehicle car. You're simply wanting to get to your destination. And so if Uber can be that platform that basically does what it does right now, but instead of with cars with drivers in them, if it can do that with autonomous vehicles, not just will it continue to be a platform of choice, in fact, its margins will probably be much, much better because the cost per mile to run an autonomous vehicle is far less than the cost to run a mobility business with a driver in the front seat. So keep that in mind. If there can be multiple robo-taxi offerings, I think Uber can remain as the platform of choice simply because they have the users, they have the scale and network effects already built in. Now, the way I can see Uber really losing is if the robo-taxi field is dominated by one or two players. Let's say you look ahead 10 years and it's just Tesla and it's just Waymo. If those are the only one or two players out there in the autonomous vehicle space, then yeah, they'll probably have their own app, they'll probably have their own fleet management system, and they'll probably cut out Uber in order to cut out that middleman. They'll instead try to become their own Uber. And then if people are really opting for autonomous vehicle rides instead of rides with a driver in them, yeah, all that demand from Uber's platform will likely migrate over to Tesla and Waymo. So really my thesis is based on the fact that I think there's going to be multiple autonomous vehicle players out there. I think this is a space where other companies will see that the margins are too juicy. I think the technologies will continue to get better, where the challenge of solving autonomous vehicle driving will become easier and easier. And so in that case, Uber will remain the platform of choice. The way I see Uber losing is if it's just Tesla and it's just Waymo out there, then yeah, there's simply no reason for them to partner with an Uber because they can simply figure it out themselves. Now, if that doesn't happen, I think Uber continues, at least in the short to medium term, continues to do just fine, which is really why I like it as a 2025 pick, also why I like it beyond that as well. So next year, you're expecting mid-teens growth of nearly 16% on that top line, expecting revenues to cross $50 billion. That's the average estimate. And you're also expecting faster growth on your bottom line, nearly 23% growth from an EPS perspective. The other really reason I'm bullish on this company is because this stock has really sold off and the valuation has now come down sub 27 times a forward earnings multiple. Again, one of the reasons why it gives me a bit of a safety margin is because you're not buying this company with all these risks at a time where the valuation is egregious. In fact, I'd say the valuation has come down significantly because of that sell-off. Now, in terms of its key financial metrics, you see growth along every core of their business. Mobility growing at 26%. That's on a top line revenue basis. You also have nearly 18% growth on the delivery side. They have a much smaller freight business as well, which is relatively flat year over year. So your total revenues grew north of $11 billion. That's on a quarterly basis, up nearly 20%. You're also seeing margin expansion from 28% up to 30% on the mobility side. Also slight margin expansion on the delivery side as well. So really that's what makes me excited with Uber. You're continuing to see that growth on the revenue side and the margin side. You also have your gross bookings, which tells you the demand for this company continuing to move up 16% year over year. So those are some of the reasons why I am bullish on Uber. Moving on to my third stock pick to buy for 2025. This should, again, probably come as no surprise. It is shares of Google, which are up 46% over the past 1 year. Year to date, you're up nearly 37%. In fact, more recently, the stock had been underperforming, but over the past 1 month, shares recover really nicely, up nearly 7% just over the past month alone. Keep in mind, you also now get a dividend with shares of Google now trading closer to a $2.4 trillion market cap. I think this one, despite its solid run this year, you still, in my opinion, have room to the upside. Now, the first thing I want to talk about is Google launching a competitor to OpenAI and really basically expanding on their existing competitor, which is Gemini. They're launching Gemini 2.0 as the competition in that space begins to really heat up. So you have competition from, of course, OpenAI with ChatGPT. You also have competition from Microsoft in terms of Copilot. And then you also have competition from other LLMs like Anthropic, like Claude and Perplexity as well. So keep in mind, there's a lot of competition in this space. Gemini 2 just got rolled out, so I'm sure they'll have something to say about that. Now, you had Google CEO Sundar Pichai go and fly out to Mar-a-Lago to meet President-elect Donald Trump. Now, the reason I'm mentioning this story is because you have recently a lot of these big tech CEOs go down to Florida to meet with President-elect Trump and really get on his good side. They saw what that did for Elon Musk. You had Mark Zuckerberg recently fly out there. You also had Amazon's Jeff Bezos try to get on the good side. Now you have Google CEO Sundar Pichai trying to get on the right side of Donald Trump. Now, hopefully that will play out in the favor of Google, because you have the DOJ, or the Department of Justice, seeking to spin off Google Chrome as it pertains to a monopoly in terms of the browser business. So this was one of the reasons why Google was seeing a sell-off over the past, because they had these black clouds regarding the DOJ saying that Google is a monopoly and has been using unfair strategies to skew competition, making it difficult for smaller search engines to gain traction. They also said this is unlawful behavior and the playing field is not level because of Google's illegally acquired advantage. So the DOJ really throwing down the hammer in terms of calling Google a monopoly, saying that it's illegally done some things that's removed competition from its traditional search engine business. Now, the first thing I want to point out is we just took a look at the story that Google has a fair amount of competition. Now, yeah, sure, this is in the AI search business and not in their traditional search business, but certainly if you take a look, Google now is facing a ton of competition as it pertains to the next set of technologies as it pertains to the AI query-based search business. So in my opinion, I'd say the DOJ is at least a bit late in calling Google a monopoly based on its traditional search business, because now, in fact, its traditional search business is under siege based on query-based products, like we said, with ChatGPT, with Anthropic, with Perplexity. And so ultimately, the DOJ is wanting Google to not just sell off Google Chrome, but in fact, if that doesn't work, sell off its Android operating stack, along with banning it from purchasing or investing in any search rivals, other AI-based products, or advertising technology. So in my opinion, DOJ far outstepping what they should do in terms of regulating a big tech company. I know Google has come out there and said that these sort of demands will really hinder the sort of experience they're able to provide their customers with Google products. A lot of these Google products will end up just being sold off, and they simply won't be as good for the end consumer. And so with that, we'll have to see what this trial that's scheduled for April 2025 really holds. You'll have both sides present their arguments. I think one of the reasons why you have Sundar Pichai flying down to Mar-a-Lago to meet President-elect is to basically tell him that, yeah, the DOJ is really overstepping its boundaries in some cases. I think a lot of this is due to high amounts of regulation. As you have the incoming administration really crack down on that high amounts of regulation, we'll have to see how this antitrust trial really plays out. I think all in all, moving forward, I wouldn't really expect Chrome to be spun off. If it does, I think that could be, in fact, beneficial to Google in some cases, because you have a sum of the parts valuation at that point, which in fact could be better. But I think long term, it will absolutely hurt Google. I think what you're more likely to get out of this antitrust trial is a slap on the wrist, maybe a hefty fine, along with opening up third-party search engines into the Chrome browser. You'll probably have more access for competition to enter there. Now, the other thing I really like about Google is the fact that the cloud business is really starting to shine through and show meaningful amounts of operating income. You have the cloud business go from a $266 million operating income same time last year now to a $2 billion operating income figure on a quarterly basis. So that's really impressive. The cloud business, which is still third place behind AWS, behind Azure, is really starting to take shape. All those investments into the cloud business over the years over at Google really beginning to shine through. I think the operating income is similar to Amazon, is really what I'm excited with Google moving into next year. The other reason I really like this company is you have probably a top 5 balance sheet on Wall Street. You have nearly $93 billion in cash equivalents, and marketable securities. That's not offset by a ton of debt, just $13 billion in long-term debt. So you have a boatload of cash sitting on the balance sheet. And again, as you have Sundar Pichai talk that good music into Trump's ears, and I think as you have a looser M&A environment, yeah, some of that cash probably could be used for some mergers and acquisitions, along with, again, you have that dividend. You also have a huge buyback in place for this company at the current time. Now, the valuation on this company is also not overly egregious. In fact, you have nearly 11% growth expected on the top line for next year, 12% earnings growth, and trading at just around a 22 times forward earnings multiple. Again, you don't have an overly egregious valuation, which makes me comfortable stepping into Google near these levels. And certainly if those black clouds continue to hang over the stock, I think the valuation will remain compressed until those really go away. If you have no news that really comes out of there, if Chrome ultimately is not spun off, I think you'll see a re-rating on the stock and you'll see that multiple expansion as a result. So Google is the third pick of my top 5 stocks to buy for 2025. Next up, we have one of the truest monopolies out there in the market, and that is ASML Holdings. We've only covered this company once here on the channel, but boy, do I like ASML. Year to date, you've seen underperformance with this name, down 6%. Keep in mind, you also get a yield with this one, and you're not at a overly egregious valuation. We'll talk more about the valuation as it pertains to ASML. So we've talked about ASML once in the past. This is a company that manufactures really complex, in fact, some of the most complex machines on the planet for semiconductor manufacturing and really chip manufacturing as it pertains to that. So there's this article by Quarter, which I'll leave in the description. It's a really good read, but it really describes the life cycle of the lithography machine, which is really the equipment that ASML produces, and tells you some of the intricate details behind that. So I'll read some parts of this. I think it's really important as it pertains to understanding ASML's true dominant moat and the business behind them. So when a chip manufacturer such as TSMC or Samsung invests in these lithography machines, it's not just purchasing a piece of equipment, it's acquiring a long-term asset with a multi-decade partnership. In fact, the machines that ASML produces are built to last, and it shared that 90% of all machines that it sold over the last 30 years are still operational, which is pretty remarkable considering how complex each one is. Now, it's super important these machines continue to operate for decades because the capital cost for building out a single cutting edge fab is astronomical, usually exceeding $15 billion. In fact, ASML has mastered the art of keeping these machines not just running, but improving. They offer services to upgrade and enhance the machines even decades after installation. They have service staff available 24/7, and that means the machines purchased today can continue to become more efficient and more productive over the next few decades. This ability to upgrade also ensures that customers continue to see value in their investment, further incentivizing them to purchase machines from ASML and remain loyal for their future needs. Now, the revenue model of ASML reflects this long-term relationship, and so the machines only account for nearly 75% of the total ASML revenue, while the other 25% come from the services and field operations, which includes maintenance and upgrades. And so that diversified revenue stream also helps ASML maintain a steady source of income, even though the semiconductor industry, which experiences its inevitable cycles. Along with that, the staff over at ASML is highly specialized, and the process takes roughly around 2 years, adding to the complexity of this company's operations, bolstering on their competitive advantage. And next up, you have the industry that has been relatively cyclical over its past, but I'd say ASML is somewhat protected from the cyclicality because of its unique position. It's the only manufacturer of certain lithography equipment, and so if a manufacturer like TSMC or Samsung wants to build the next generation of chips, they will have to go through ASML. There's no other competitor to turn to, and manufacturers like TSM will be hesitant to cancel orders even in tough economic climates, because they'll know they'll lose their place in the queue when the demand inevitably picks back up again. So there's a lot of things that make ASML very dominant. You have that, of course, selling the machines that are very complex. You also have the services side of their business, which again is very difficult to replicate because understanding these machines requires a staff that's extremely specialized. they're also pretty much the only company out there putting together these extremely complex machines. And so that cost of replication is very, very difficult, really why no other company has tried to challenge ASML. So I think that is ASML's moat, basically gives them a monopolistic position in the semiconductor industry. Now, you also had news that the US did put restrictions on China's access to certain AI chips, along with certain AI tools as well. So the US did restrict 27 types of HBM, which is high bandwidth memory, and chip making equipment, including products made outside of the country by American companies. And so that does include certain types of equipment sold by ASML into the country of China. Now, ASML did come out and say that those export curb control rules won't impact guidance. In fact, their 2025 guidance remains intact in nearly $30 billion up to $35 billion, in euros, similar on a dollar basis, but that is in euros. In fact, they said that they do not expect any direct material impact on their business from the new semiconductor export curb controls enacted by the current administration that we're in. So again, this is something that will impact ASML based on what the new administration says. If they maybe increase export curb controls, then that could have a material impact on ASML. If they perhaps loosen them, it could benefit, because I think ASML sells about 20% of their revenue into the country of China. And so not a huge portion of their overall revenues, but still a material business. Now, you have nearly 15% growth on the top line expected for this company, revenues coming up to $34 billion for the full year next year. And what's really interesting is you look at how this company is expected to grow over the next few years. Into 2030, you have the average estimate on Wall Street at $58 billion in revenue. In fact, you have the high-end estimate at nearly $60 billion in revenue. So from $30 billion of revenue in 2024, you're expecting them to nearly double full-year revenues into the year of 2030 at $60 billion. So if that certainly continues, that is bullish for ASML. And one of the reasons why I like this company as a long-term buy and hold growth story. And speaking of growth story, you have phenomenal growth on the bottom line, as you have earnings per share expected to begin to rise once again into 2025, nearly 22% growth. And on top of that, you don't have an overly egregious valuation. Again, under 30 times. It's difficult to find valuations like this at a time when the market is absolutely red hot. And so in my opinion, at the current time, it's extremely important to pay attention to the valuations that these companies are trading at, because if you expect that pullback in the markets, that will eventually happen. I think companies that are already trading at a relatively low forward valuation will, I think, see some protection to the downside. That was stock number 4 out of 5 in terms of my top 5 stock picks for 2025. Last but not least, we have a company that I recently talked about, and that is Adobe Incorporated, which is sliding again after reporting their Q4 results. Shares took a beating, down nearly, I believe, 17%. And yeah, that decline is continuing to extend in the subsequent trading days. So shares of Adobe really haven't caught the bid that the rest of AI software names like Salesforce, like Palantir, even like ServiceNow have caught over the past year to date. And so shares certainly have underperformed. Now, I think Adobe is one of those enterprise software names that is a bit misunderstood. I think they're taking a bit of a different approach in terms of the AI story, and that narrative really isn't playing out with this one. I think you'll have to give it some time in order for that narrative to play out. We talked about Adobe extensively when we covered it recently on the channel in terms of its Q4 report, so be sure to check out that video as it pertains to Adobe. I'll have that linked in the description as well. So as it pertains to Adobe, I think you're picking this one up at a relatively, again, inexpensive valuation. There are some fears around how this company will monetize AI moving forward. I think they'll do it just fine, and when it happens, the AI narrative will suddenly flip on Wall Street, and well, we know what happens then. You can take a look at shares of Salesforce, which earlier this year didn't have that AI narrative baked in, and then suddenly that momentum flipped. Those were my top 5 picks heading into 2025. To recap, we picked Amazon, which is a leader in e-commerce, cloud, and now, of course, advertising. Uber, which is a bit of a contrary pick as it pertains to mobility delivery. Also, if you expect a travel boom to continue into next year, I know the airlines are expected to post record profits. I think that travel spend will continue to increase, and Uber will take advantage of that. You have some black clouds hanging over Uber as it pertains to robo-taxis, but I think in the short to medium term, that is not happening. In the longer term, that has a potential to happen, but I think Uber has many ways to to figure out the robotaxi autonomous vehicle story. And so I think they'll be just fine there. Google, which is an undervalued advertising plus cloud play in my opinion, they also are making major leaps as it pertains to AI and quantum computing. ASML, which really hasn't caught the semiconductor rally throughout the year, but I think the future looks bright for this company that's really dominant, has a very strong moat, and is pretty much a monopoly in its field. And then Adobe, similar, hasn't caught that enterprise software bid. I think the AI story is still coming over at Adobe, and when it does, I think Wall Street will recognize it and the company will do just fine. So moving into 2025, you have some tailwinds acting in your favor. You of course have growing earnings from pretty much all of these companies. They're expected to grow earnings somewhere between 10 up to 25%. You also have still the expectations of rates continuing to be lowered, maybe not at the pace that they were in 2024, but you probably have still some rate cuts coming, at least in the first half. Along with that though, you do have some headwinds in my opinion to watch out for, namely the first one being high valuations on many names. Like we said, the markets have rallied into year end, and so you have extremely rich valuations on a lot of stocks. If you see that pullback, if you see a sell-off, a lot of those high valuation names, in my opinion, will take the majority of the beating. You also maybe could have a slowdown in AI spend in the second half of next year. In order to gauge that, I would really pay attention to what the hyperscalers like Amazon, Microsoft, Meta, and Google really say on their conference calls. Will they say that they're pulling back on AI spend and waiting for that ROI to maybe begin coming in? Or perhaps they absolutely won't say that and they will come out and say they expect to spend even more in 2026 than they did in 2025. So you could potentially have a slowdown in AI spend in the back half of next year. The wild card, of course, remains as we head into January and the new administration comes into office in the United States. You have some policies that could benefit, such as lower corporate taxes, possibly like deregulation on the autonomous vehicle side, but you have some policies that could really impact stocks, especially doing business out of China, such as higher tariffs along with tariffs from products sold from Canada and Mexico. So you could have some policies that could go either way. I think some will benefit, some will probably hurt the markets overall. So keep that in mind. Make sure to have a well-balanced portfolio as you head into next year. I think a lot of tech names will probably continue to do well simply because earnings will continue to do as well. Hope you guys enjoyed a video like this. Let me know your thoughts on these 5 stocks in the comment section below, whether you agree with them, whether you disagree with them, or perhaps you have other picks that you think will perform better and outpace the performance of the S&P 500. Happy New Year, happy holidays, take some time off, spend some time with your family. I'll check back with you very soon as we have earnings coming up from Nike, I believe sometime next week. And so we'll take a look if this year-to-date performance perhaps improves as it pertains to that one. Thanks so much for listening, and I'll catch you guys in the next video.